Hi everyone, welcome to our DAT IQ Weekly Market Update. This is our update for November 25. It's episode 316. I'm Dean Croak, Market Analyst here at DAT, along with co-host Chad Kennedy and good friend Anthony Smith. Anthony, welcome to the show. We've been wanting to have you on for a while. I'm glad you could join us.
Dean, thanks so much for having me. Chad, great to be on with you guys. And yeah, I've been wanting to get on for some time now. Happy to join. Always been an amazing colleague, mentor of mine. So yeah, happy to start and get going today.
Yeah, it's good. I always valued your economic expertise as it related to the truckload market. You and Ibrahim both taught me a lot about macroeconomics when I was, when we were both at FreightWaves. Chad, how's things in Florida? Things have calmed down. We've only got 2 weeks to go on the hurricane season, so I guess it's all but over.
Yeah, I think it's over. I hope there's not going to be another storm that's going to sneak in here in the next couple of weeks, but and it's finally cooled down quite a bit. We get lows in the 40s, which has been really nice.
That's good news.
Welcomed. Yeah.
Anthony, for those that don't know you, and there's probably not too many, tell us a bit about yourself and what you're doing.
Definitely. So I am a corporate economist and independent economist, and primarily I love looking at macroeconomic trends. I always kind of go back to what's happening and what the conditions are for the consumer, and also look at very high upstream as well for manufacturing and corporate trends as well. And so I've had the honor and privilege to work with a variety of industries within manufacturing, construction, residential, non-residential, and really lately looking at what it all means for the supply chain and tying it all together to what it means for freight and freight demand. So really have been fortunate to be a jack of all trades within the macroeconomic realm, from building product materials and micro trends to at the large scale as well.
Yeah, we had Dustin Jalbert from Fast Markets on our show a little while ago. He's a good friend of yours. I think you worked together back here in Boston back in the day.
Exactly right, Dustin. Another amazing economist, another, I would say, a mentor of mine that kind of helped me get into the industry early on back in the day. So he really kind of helped me ramp up, especially on the forestry product side over at Fast Markets. At that point, Reese, but amazing resource over there.
Yeah, good. All right, we'll bring you back in a little bit later to talk more about macroeconomics. Lots to talk about there. In the meantime, I'll dive into the freight market update section and bring Chad in to talk about the contract market. Some of the key trends we're watching: spot rates rose across the board last week, more so regionally in reefer as fall produce, ham, turkeys, Christmas tree shipping season intersect. Interesting data point last week from the USDA: 46 of the last 47 weeks. They've reported an adequate supply, even a surplus of trucks on many occasions in the 20 produce growing regions. That's amplified how soft and oversupplied the reefer market has been. Last week, there were two markets for the first time this year that actually reported a shortage. No surprise, Twin Falls and Columbia River Basin, both where a lot of Christmas trees are coming out of there. Things like Oregon, for example, markets, loads moved in that market. Reefer loads were up about 39% last week. Even go over to Raleigh, North Carolina, where a lot of hams are moving. Volumes are up 35% in the last month. So you can see a lot of produce moving. You can see a lot of ham and turkeys moving ahead of Thanksgiving this week. So obviously this time of the year, we start to see reefer rates tighten regionally. They've pretty much done that exactly. ATA tonnage index came out up about 1.2% in October. Bob Costello said that the freight market has improved, albeit slowly, over the course of the year. Volumes are up about 3% year to date. Housing starts, we'll talk to Anthony about this at the end of the show, but single-family housing starts were down in October, sharply decreasing in the south and northeast. The south is where about 50% of single-family homes are built each month. Permits did rise, though, so it'll be interesting. But I think some of the drop in single-family housing numbers were due to the hurricanes Helene and Milton that hit the southeast. ACT Research 2025 forecast is out. It's a great read. Tim DeNoyer writes about the US economy, talking about a modest slowdown, GDP growth. We'll have Tim on the show here in a couple of weeks to dive into that a little bit more. And in this week's market update that will be out this evening at dat.com/market update, we're looking at steel production, which is at a 5-year low. We're talking about the potential impact or non-impact of the drug clearinghouse phase 2 implementation. In Chad's backyard, Florida produce farmers are still struggling with the double punch that they got from the 2 hurricanes that came through that area. And we're looking at some of the Census Bureau data on residential construction in the market update that'll be out this evening. So let's talk about load to truck ratio. Load posts down a little bit last week. Load to truck ratio up about 28% to 4.46. Capacity normally tightens this time of the year on higher demand. In the refrigerated market, load posts were back last week, up about 8%. Load to truck ratio ended the week at 6.84, up 21% week over week. And in flatbed, the load to truck ratio ended the week up also about 20% at 12.63. Having a look at our year over year look at spot rates, even though the volume of loads moved, increased by just over 6% last week, there definitely was a shortage of capacity to meet demand. Rates went up a penny per mile. That's the national 7-day rolling average. At $1.67, spot rates are about 5 cents a mile higher than last year and sitting about 6 cents a mile lower than 2022. Compared to the 3-month trailing average, rates are about 3 cents per mile higher last week. And in the refrigerated market, reefer rates continue to heat up ahead of Thanksgiving, right on schedule. Last week, they were up 3 cents a mile and 9 cents a mile in the last month at $2.06 a mile, excluding fuel. Line haul rates are sitting about 9 cents a mile higher than last year and about 4 cents a mile lower than 2022, and sitting about 7 cents a mile higher than the 3-month trailing average. And in the flatbed market, flatbed rates were up just under a penny per mile last week to a national average of $1.97. Loads moved were up about 4% last week. Compared to last year, they're sitting about 9 cents a mile higher than the black line you can see on the chart there, sitting about 5 cents a mile, also lower than 2022, and about 2 cents a mile lower than the 3-month trailing average. Having a look at our short-term forecast out 35 days, our new format, we have Ratecast is in green. That's the, we're predicting what rate view will be 35 days out. It more heavily weights longer-term seasonal trends. It's bounded by an upper and lower forecast band in yellow and red. And of course, the blue line is the rolling 7-day weighted moving average of historical rates for actual loads moved over 550 miles, excluding fuel, so really just pure line haul. You can see a very solid movement up and to the right on all of our models today. Again, strong seasonality is entering the market. That's nothing surprising here. Models are showing pretty much what we see this time of the year. Ratecast in dry van is looking for an 11 cent per mile increase through 12/28. So this is the first forecast this year. We'll see the true impact of the holiday season and then the tightening of capacity after Christmas when drivers take time off. The lower band is still looking for a rise of 4 cents a mile, and the red line, high case scenario, up 19 cents a mile. Last year, Ratecast expected a 10 cent per mile lift over the same period. Ended up being about plus 8 cents a mile. So I think Ratecast has pretty well been on the money all year round. Reefer again shows this solid seasonality. Rates look like to have peaked ahead of Thanksgiving as of last week and over the weekend. They're expected to drop about 5 cents a mile to the end of next week before the final 2 full shipping weeks occur in the lead up to Christmas. Rates will go up about another 20 cents per mile by then to 12/28. Best case scenario up 22 cents, low case scenario up 7. And in flatbed, this year the models are expecting a much stronger finish than they were last year. Ratecast is expecting a 9 cent per mile increase through the end of the year. The low case scenario is still up 4 cents a mile, high case scenario up 14. I think Ratecast has pretty well been on the money most of the year. All right, so that's the spot market. Let's go over to Chad to talk about what's happening in the contract freight market.
Yeah, thanks, Dean. So everything Dean just covered is from a broker to carrier perspective in the spot market. I'll cover the relationship between spot and contract rates for shippers. So this first graph here at the top here in yellow is our spot premium ratio. It measures the premium spot rates are demanding over contract rates. It goes back to 2016. So you can see the market boom and bust cycle there. Still quite soft at negative 8.7%. For our most recent week of data there. I did get a sneak peek into last week's data, and it's hovering around that same area, around the negative 8%. So no significant pressure there. We're looking for that to hit up above 0 for a clear signal that the contract market is starting to turn significantly. And then in the new rate differential, the blue line there in the middle, this measures the percentage difference between new contract rates and those that they have replaced. So it answers the question, what are shippers yielding from their contract RFPs. So we're at negative 0.5%. It's really been bouncing around zero a few weeks there, above zero. And this lines up with the feedback that we get from our shippers when we talk to them that RFPs are basically yielding some increases on some lanes, some small decreases on other lanes, around 0 to 1% increase overall. And the contract rates there in purple there, this represents over 80% of our data on the shipper side that our shippers contribute to us. Very flat, kind of dragging along the bottom here. And this is a relative metric to 2017, that contract rate index. Moving on to reefer here, spot premium ratio, negative 3.8%. You see a nice trend with some momentum there pointing north, which is a good sign for brokers and carriers, bad sign for shippers. It does look like those reefer rates are starting to have some upward pressure, especially in the spot market, but not so much on the contract side yet. We're still at negative 1% on that new rate differential, and you can see the contract rate index still dragging along the bottom there. So on to flatbed, last but not least, a lot of volatility as always here in flatbed with a lot of seasonal short-term rates. Spot premium ratio still negative 8%, new rate differential at negative 3.8%, and contract rate still dragging along the bottom here. And then finally, to wrap up with all three graphs from a rate per mile perspective on the shipper side, some of these rate per miles will differ from what you see from Dean because these are the contract contributed data, so different lengths of haul and so forth apply here. But you see the spot rates still below contract rates, and you see that in the middle there, the reefer rates climbing in the spot category in yellow there. And on the bottom there, flatbed rates, spot still lower than contract rates. Interesting phenomenon here. I think the planets aligned. We've got $2.11 in all three categories. This is not really a great comparison to each other because different lengths of haul in each of these, but fun data point there to point out. That's a wrap on contract rates.
Yeah, thanks. We're all about fun facts on the show.
Sure.
Chad, I was looking at the next 6 weeks, right? So we've got 3 short shipping weeks in the next 6 weeks until the first week. So how do you think that's going to pan out? Because we normally see shippers advance some of their shipping volumes ahead of short weeks and then take more time off. How do you think that'll play out this year?
Yeah, I think it'll get compressed into those 2 weeks. I know that we always see some volume dips during the holiday weeks. So Thanksgiving week, we'll see a small dip. Christmas week and New Year's week, we'll see those small dips, just like any other national holiday that we see across the calendar. So I know that spot rates may peak during those weeks too, as we see some routing guide leakage, leaking out to the spot market a little bit more. But overall, shipper volumes will drop a little bit. Does have some cost implications for shippers when it comes to dedicated and private fleets. They take kind of the burden of that versus when they're hiring out one-way rates. So the shippers from a cost per unit, cost per load, do take a little bit of a hit during those weeks. And you get a little bit more freight from a percentage perspective leak out to the spot market.
Got it. Okay, thank you. All right, so let's bring Anthony back in. Anthony, let's start off with what we think the state of the economy is going into 2025 and what you think some of the challenges might be in the coming quarters.
Definitely. So I think right now, one of the big things, if you were to rewind the clock, say maybe a year or so ago, I think the thing that was on everyone's mind is that there is this recession that's going to be coming and it's going to hit. It's just a matter of time, sometime in 2024.
Right.
And I think as you fast forward, you surely have seen maybe some segments of the economy that have maybe experienced contraction or recessionary trends, but as a whole, the overall GDP didn't have, contraction or back-to-back quarters of contraction. And what we saw was really the consumer coming through, and Americans do what they do best, and that is just spend and consume. And of course, you also saw some upward movement from infrastructure, I think, especially in this last few quarters here, spending as well, adding to some of the GDP overall. So I think when we're looking at the U.S. economy, we see some growth, slower growth in a lot of segments, but growth nonetheless. And I think as we're going into 2025, there is a lot of things to be, I think, optimistic about, for sure, with the momentum of the consumer, but definitely a lot of challenges ahead. So as we look at the U.S. consumer, backbone of the U.S. economy, we are seeing that the labor market is softening. Although unemployment is at 4.1%, we are seeing that the job opening levels are far away from those historic highs that we saw post-pandemic. And so we're seeing that return back to, historic trends. We are seeing that the consumer debt level is quite a bit elevated, much higher than we would like to see. So that's going to be a concern and definitely a trend to watch. And on a macro scale, of course, I think there was a significant holding pattern for a lot of individuals, waiting to see what the outcome of the election was going to be and then planning accordingly. So I think there's going to be, a lot of potential pull forward, a potential reconfiguration of certain segments now that we know it's going to be a Trump presidency over the next 4 years, whether that looks like, some pull forward or reconfigurations of suppliers, especially upstream with manufacturing, and really understanding how to play into the dynamics of proposed tariffs that may be on tap coming up.
Mm. Just on that point, Anthony, Bloomberg had a good article out last week talking about an even longer pause, because one, we are waiting for the outcome of the election, but then it takes time for policy to actually form, and then companies will know. So they were talking about the middle of next year before we'll really know what direction companies are going to take. Do you agree with that we could have this extended period now until the middle of next year?
Certainly, and I think, when you look at businesses, of course, they're usually headed up by very brilliant people, and so they're going to have the leeway and the time to adjust, and so that's going to be a big benefit. Another big thing that a lot of folks I don't think realize or take into consideration is, one of the big things is around tariffs and how quickly they can shift or how slowly they sometimes are coming into play. And so when we saw the Trump presidency and the tariffs come into play in his previous presidency, then we saw Biden take office. There was a lot of expectations that those were just going to get shut off completely, but in fact, we saw that there were some that were added on and that they stuck around for quite some time. So I think it's going to be, as you mentioned, a long and slower rolling impact, rather than just something that's going to happen, snap of the finger overnight when it comes to that tariff aspect. And of course, we also have external players as well that aren't just going to accept some of those tariffs just laying down. I think when we're looking at the aspect of nearshoring and reshoring, that's going to be significant. And then we have to look at what's going to be happening in Mexico. So when we're looking at investment within Mexico, I think you're going to start to see a lot more potential Chinese investment, and then looking around different loopholes to get to that final consumer. And what does it mean to have, a finished good or maybe a in process good moving across the borders between the US and Mexico? And does it get tagged as a Chinese import or not? What type of raw materials and what that status might be. So I think we'll start to still see a lot of holding patterns, like you mentioned, and wait and see. But I do think there's going to be a lot of gaming, so to say, as we're looking at how this will be impactful for the larger macro scale.
It's really interesting. I know the Wall Street Journal published an article on the tariff effects. I think Trump's tariffs went into effect in 2018, and you can see a very clear drop in imports from China and then a delayed increase from Mexico. I think that pattern will continue. So it'll be interesting to see how that plays out over the next couple of years. And I think you're right about this slow lag effect of these tariffs. What about regulations that any different regulatory environment that we might see from the new administration next year? Anything that could impact shippers, carriers, or brokers in this space?
Definitely, I think one of the big things is looking at what type of incentives, because that's all this really comes down to at the end of the day, is what is going to be incentivized domestically, internationally, what kind of incentives are going to be put in place. One of the things to kind of keep in mind is potential deportation, which can lead to significant shortages in certain industries of labor. And so that can be a huge hindrance potentially in certain segments of the economy. So that can really have some impacts in the near term. Most definitely, I think we're looking at types of incentives that would really be impactful. I think it would definitely be around the aspect of really ramping up that industrialization of the United States, and that could come in the form of infrastructure, warehouse construction, and also looking at what it would have what would be needed for a more resilient supply chain. So even if we start to see more industrialization domestically, we'll also need to have the infrastructure to handle that increased demand. And so I think those types of regulation will need to be in place. And so we haven't heard a lot just yet about the plans for that. But I think when we're looking at the upcoming, 4 years, we
Mm.
really need to look at the policies that are going to be in place, and will it be substantial, or will it be I think, supportive of that domestic activity? And of
Mhm.
course, we can't really kind of replace such a large partner as China overnight, or even over the course of 1 or 2 years. And so I think either way we look at this, Mexico is going to come away as a winner. We're looking at that increased investment there, the availability of labor there, that will be a little bit more affordable for international players that are willing to stay close to the American consumer. So that's definitely where I'm going to be keeping my eye on.
Mm.
And Anthony, what about the rate cuts that we've seen? So we saw a 0.5 point cut and then a recent 1/4 point cut. I think more was expected. Maybe expectations weren't met there. How do you think that plays out? And what is the lag effect of that? Is that a 6-month or 8-month lag effect that we should expect?
Definitely. I think you're spot on with that lag effect, because I think one of the big things from Fed Chair Powell was really being certain to have all the data in hand and taking all things into consideration, and making sure that this is a decision that will be measured, and not to, I would say, lower rates too quickly to undo the progress that has been made thus far. And I think you're spot on when we might start to see some of those impacts on the current rate cuts, outside of the front loaded potential impacts on mortgage levels or rates overall. We might start to see some of those impacts, 6 to 8 months down the line, most definitely. One of the big things, of course, is really making sure that the decisions of the Fed and overall, you know, demands from the executive branch or the presidency remains completely separate. And I think we saw some subtle back and forth of Jay Powell really kind of standing by and making sure that the two are remaining separate. And I think that's going to be crucial, because when we start to see the impacts of tariffs, I think majority of economists would say that tariffs usually typically lead are inflationary overall, and when applied should be more applied as a scalpel more so than a hammer or an axe. And so when we're looking at the potential impacts of some of the additional tariffs that may be levied, I think that also kind of has to be taken into account to what's going to happen with those interest rates as well. But I do anticipate interest rates slowly but steadily coming down in the upcoming year. But that measured approach is definitely going to have to be, I think, considered, because too quickly and you start to run out of tools to use in order to really kind of reverse potential resurgence in inflation, which I think will be in play
Mm.
by the second quarter of 2025. This, regardless of where we see interest rates go over the next few meetings, I think that's already kind of baked in right now.
Hmm.
Mm.
So that's interesting, Anthony. Interest mortgage rates have started to rise in the last little while. So I just wondered about the impact of that on single-family housing starts, for example. So, notwithstanding the fact we had some hurricanes that impacted single-family housing starts in October, where do you see, housing starts or residential construction going longer term with the backdrop of interest rates and mortgage rates, and how that affects, say, flatbed and then dry van carriers as homes get finished out?
Definitely. I think when we're looking at, of course, the housing market, we always have to look at what was going to be happening with existing homes. I think lately we've seen a little bit of a blip up in existing home inventory, so that's a good sign. Still not at levels where we would need to see. I think multifamily will definitely be a potential pain point in the upcoming year here. And I think overall, there's definitely, I think, going to continue to be headwinds for the housing segment. I think we'll start to see continued creativity with interest rate or mortgage rate buy downs by builders, different types of incentives being put out. I think we'll start to continue to see the South, as you mentioned earlier, be a stronghold for overall starts activity. One of the, I think, hidden trends that may or may not be, I think, impactful, maybe a little bit less impactful, but I think interesting nonetheless, is the return to office for a lot of companies and large corporations. When we see that with major corporations and really kind of putting that return to office in play, what does that do for certain markets like, say, Seattle, or Austin, or these other tech hubs in Northern California, San Jose, San Francisco, that are kind of starting to, say, hey, we are going to have you return to office. Do we start to see a subtle exodus from some of these Midwestern states that were able to capitalize on that remote work and people kind of just getting away to a lower cost of living area? Or do we start to see, more constrained activity in some of those tech hub type areas as well?
That's really interesting. Also creates an additional demand for oil too, right? As more commuters hit the roads, and also causes some congestion challenges for the drivers out there on the roads. What do you have a sense for what we could expect with diesel prices over the next year? I know this is a crystal ball question, but a lot of things that are going on that could impact this. We're into heating oil season right now. You've got the Drill Baby Drill campaign that's coming into play here in January. There's a war, in Europe, and then I think Europe announced that they're going to start buying more energy from the U.S. So a lot going on in this space. What's your view on the next year for diesel prices?
Yeah, I think you're spot on in terms of it definitely being a crystal ball. Most definitely, I think when you're looking at um, that aspect of the economy with oil, with transportation, I think looking at OPEC plus is definitely going to be a big one. I think we're looking at how much that will be, how much production may be limited to the market will be a significant one. I think the other big one is had a chance to chat with another colleague, John Kingston, of course. Great work within the space, a legend, of course. Looking at the impacts of EVs, and one of the things that was kind of mentioned was, although EVs haven't been widely adapted domestically here within the US, it's still a global driver overall. So you're looking at some of the countries in Europe, definitely much more adaptive. We're looking at hybrid, definitely a little bit more, I think, palatable here domestically. So I think when you look at that overall, I think that will be on the margin, a significant impact, maybe not a huge percentage mover, but on the margin should be pretty significant. Even with weaker US demand, I think overall we have been a leader in production. So I don't know if there's going to be enough of a lever to pull to just say, hey, keep drilling, unless it's going to be more so incentives around some of the manufacturing of drilling goods and industrial activity there. But OPEC Plus, I think, canceled a 2.2 million barrel a day increased production. And so we'll get back to, I think, that meeting, I believe, is going to be in December, because we have seen a weaker oil market overall. But you're spot on, definitely a crystal ball. Geopolitical, trends can definitely throw a wrench in anything and everything,
Yeah.
especially within this market. So that can definitely be a huge driver or game changer overall as well.
Yeah. A lot of uncertainties out there.
Anthony, John said last week that we're already drilling record levels of oil here in the US. So in terms of capacity was pretty high. It was the highest in many months at about 91.4%, I think he recorded. With West Texas at just under $70 a barrel, I remember John teaching us about oil needs to be above $40 a barrel for exploration companies to make money. So the general trend, though, of oil has been down. We're producing the most number of barrels of oil per day already. So the question is, like, how much more room, how much more I mean, how many more holes in the ground can we drill that require flatbed loads of drill pipe and casing? So my view is that I think we're kind of tapped out in terms of the impact of more drilling on the flatbed market. I'm curious as to whether you see it the same way.
I do, and I think that's one of the big things because I was really surprised. So, of course, as an economist, I'm very much apolitical, and really want to look at the policies. But that was one of my surprise, takeaways as such a huge talking point of the drilling activity. And I'm really kind of there with you. Is that from what I've seen and have been able to analyze and conversations with industry experts, we're drilling a pretty significant amount, and so. That's where it kind of makes me think of what type of incentives that maybe there will be for those producers to continue production or make production cheaper or really kind of continue to, maintain that stronghold. So that's where I'm really going to be curious to see what kind of policies really kind of take hold over these next few years to really kind of maybe incentivize maybe margins potentially for producers. And so yeah, I'm right there with you. And also it's going to be curious to see how OPEC Plus continues to, potential curtail production overall in the upcoming years here.
Right. On the subject of flatbed, we've got Zach Rogers on from talking about the LMI next week, of course, a colleague of ours and expert in the logistics field. I'm curious as to how you see the differences between the ISM PMI and, say, LMI as it relates to truckload demand. What should we be watching for?
Definitely. Huge shout out to Dr. Zach Rogers and the gang over there at for the LMI. I always forget one or two off the list of Rochester Institute of Technology at ASU, Reno, Nevada, Colorado State. A lot of great contributors there, but definitely headed up by Zach Rogers. And I think when we look at that and at the glance for the most recent LMI, one of the things that I think was mentioned was essentially everything is in expansion, whether it's slower or faster, it's in a general expansion overall for the logistics managers index. I think we still see that there's still quite a bit of capacity on the roads, and that's just going to be such a huge, significant headwind for the overall market. But I think we're looking at the PMI, I think that's a whole nother story. So I think we're looking at the manufacturing index overall. It shows that there are continued headwinds. I don't think we're starting to see that, okay, we've turned the market here. So I think there are certain individuals that want to just be so quick to say, okay, this ongoing freight recession's over and we're headed to the moon. But there's just so many other things at play here. And when we're looking at the upstream aspects of it all, looking at manufacturing, the PMI is still showing that we're in contraction. We're looking at, so for example, non-defense capital goods new orders, excluding aircraft, on a year-over-year basis. There's just a significant holding pattern right now. So we're seeing, if you were to chart that out on a quarterly year-over-year basis and a 12-month year-over-year basis, it would almost just kind of be this moderating trend, not surpassing really 0.5 movements either way. And so looking at a leading indicator of a leading indicator, so to speak, when we really start looking at the new orders component, we're still seeing that in contraction for the PMI or the ISM PMI. And then looking forward to that, usually when new orders are satisfied, we can expect those upstream to start to operate some of those backlog of orders. We're still seeing those backlog of orders are in contraction. And so those aren't, at a significant surplus for those to start being drawn down. So overall, I don't think we've seen the significant upward movement for manufacturing just yet. Potentially, if we start to see some incentives for this upcoming administration for manufacturers, maybe we'll see that spur that will be needed for some of those upstream activities. But as well, interest rates don't just, impact consumer decisions. It also impacts, business decisions as well. And so capital good expenditures are going to be more expensive. And I'm pretty sure if we were to look at the expectation of increased interest rates, we also saw a lot of upstream manufacturers pull forward a lot of manufacturing activity and pull forward a lot of would-be acquisitions or capital expenditures ahead of those increased interest rates. So I think now we're starting to see on the back end of that potentially more upstream manufacturers maybe holding off on capital good expenditures before we see maybe lower interest rates. So I think right now, upstream manufacturing, we still haven't seen that sudden jolt or spur just yet. Still in contraction overall, and a lot of holding patterns when looking at, for example, industrial production or new orders of manufacturing or machinery and things like that.
Okay.
Maybe there will be certain segments like automotive that maybe can buck the trend overall, but overall, when we're looking at manufacturing as a whole, still definitely a lot of contraction there.
Chad, you want to fire off one more question before we wrap up? What do you got?
I wonder, I'd love to hear from both of you on the Drug and Alcohol Clearinghouse. I think we had some change in rules last week. I didn't see anything really come out of that from a rate perspective, but how significant is that change? And do you think it would have an impact on rates in the short term? Or is this just another small move in the supply?
I think a nothing burger.
Nothing
coming, after. And here's why. I mean, we could never really figure out the impact of the Drug and Clearinghouse because capacity is already decreasing in 2020 when it was introduced, and then we had the pandemic. So you can't really pinpoint, did it result in a tightening of capacity, because capacity was already loosening. Now, most carriers have already been following the clearinghouse rules and not allowing drivers in a prohibited status to drive trucks. So the drivers that were in violation of substances were not, but by and large, not driving trucks anyway. Phase 2 just takes away their CDL. I know from experience talking to a lot of carriers that if you were caught with some sort of substance, there's a good chance the vast majority of those were not going back to driving trucks anyway. This just makes it permanent. We've been in a soft market for a couple of years. I don't think there was any impact at all of this rule. If there was, Chad, I think it might have been early in 2020, but again, the market was already losing capacity then, so it was hard to say what the impact is. Some argued that it'll improve road safety. I sincerely doubt that. There's lots of other reasons for drivers to be unsafe on the road. Substances aren't one of them.
Yeah, makes sense.
And Dean, I had a quick question. It's a little bit maybe out of the dark or whatever, but I think about as a just everyday driver.
Right.
I am old school. I still drive a 6-speed manual transmission vehicle. I love it. And then sometimes I'll get into a vehicle that a friend is driving or something like that, and I see all the amazing technology around. I see the lane keep assist, all these other things,
Right.
and I'm curious if we start to look at it on a freight level. Do you see that technology or automation potentially making drivers or not as skilled as they used to be, and kind of lowering the barrier of entry for skill? So because I see almost like automation isn't here, probably won't be here for quite some time, but do you see that driver skill really starting to potentially diminish as we look forward?
Yeah, I think technologies has enabled, we've dumbed down the whole driving task because we put this safety net of technology around. Almost anybody could step into a truck today and have, adaptive cruise control, collision avoidance, lane departure. There's all this technology that sits around the driver. Unlike myself, who had to learn from experience and making mistakes, you don't have to do that these days. You can enter the industry relatively unskilled and drive or steer. I won't say drive because that's a whole different skill set from actually driving a truck down the road as opposed to steering. Most people can get in a truck and steer it down the road these days without any difficulty. So I think what we've done through technology is actually lowered the barriers to entry. You're 100% correct. But what we've also done, Anthony, is that increase. We've got this thing called task saturation that goes on inside the cab, where you've got so many things to watch and so many LED screens in front of you. You actually have this higher level of distraction in front of your eyes, particularly at night with all of these screens. and it reduces your visibility, particularly your periphery when you're looking. So, I mean, if you got in my Peterbilt, it's all black and my lights are all dim, so you can see outside. That's very different than most trucks you pull alongside these days, where you can see an iPhone, an LED tablet, like music, iPad, and then the ELD device, and then the digital display, and like you've got all these lights. There's a lot of distraction that goes on. So yeah, but there's a different generation of drivers too that grew up with technology. So a lot of the newer drivers are tech savvy and they're quite okay with the tech side of it. There's just a whole different driving task out there today. And it's a real debate between new school and old school. It causes a lot of debate and angst on social media. But that applies to everybody, even cars. Like we talk about people needing to be safer, yet it's okay for a Tesla to have this 15-inch by 15-inch screen right in the middle of the dash. Like, what are you watching? You're watching the road, or you're watching the screen with all the vehicles moving? That's the bit I can't figure out about road safety.
Yeah, I'm definitely there with you. And I think we're starting to just see technology be infused with anything and everything.
Yep.
And for the better or worse, I think that's going to also be a potential factor within manufacturing and automation. Definitely interested to see how automation continues to take hold upstream with the Internet of Things, AI really kind of taking hold, and we'll see where the applications will be or won't be. So yeah, I'm right there with you. But yeah, thanks for clearing that up for me.
Yeah. Yeah, we've loved having you on the show here. Last week, Anthony, we had a good T-shirt slogan from Nicole Glenn. Grit to grind was the way she described 2024 to 2025. I think I might get this week a leading indicator of a leading indicator. I think that could be that's quite a good one. We've got a month of rock stars of the macroeconomic world coming up. Next week, we've got Zach Rogers, the week after Jason Miller, and then we wrap up the year with Tim Denoyer. So we've got a full month, including yourself, of macroeconomists telling us about what they think about 2025. Before we wrap, give us a one-sentence view of how you think the truckload market's going to look next year, and then we'll bring you back on at the end of 2025 to see how you did.
Definitely. I think real quick, I think it will be a slow but steady pace of recovery. And I think with a caveat of a gray swan event. Won't call it a black swan, but maybe a gray swan event.
Oh man, okay, a gray swan.
Great.
I'll be on the lookout. That's awesome. Loved having you on, Anthony. Before we go, how can people get in contact with you?
Definitely. So Smith Charles Anthony at gmail.com. Feel free to reach out. LinkedIn as well. I have to kind of brush up my LinkedIn and get more active on there. So apologies for those that have been used to seeing me active on LinkedIn. I will get back to it. But Smith Charles Anthony at gmail.com, and feel free to find me on LinkedIn as well.
Yeah, thank you. We'll have the link to this show on LinkedIn from DAT Freight and Analytics out tomorrow. Thanks for having you on. We need to get you back on a regular quarterly basis to talk about truckload macroeconomics. Thank you for being on. On this week's Freight One podcast, Professor Kaplis is talking to Kevin Zwire from Chainalytics. I'll be on with Jimmy Mack on Thanksgiving. We do our regular Thanksgiving show on Thursdays on Channel 146. As we mentioned, we've got Zach Rogers on next week. Make sure you set up the alerts for the show. Happy Thanksgiving and safe travels if you're one of the 80 million travelers who will head 50 miles or more from home over the Thanksgiving holiday period. Be safe, everyone. With that, another show's in the book or books. We'll see you next week at 10 a.m. Eastern, 7 a.m. Pacific.